Imagine you're walking up to a cash register. You swipe your debit card to pay for your weekly groceries, and the terminal just flashes declined.
Yeah. And it's not because you're out of money.
Right. Not because you're broke, not because the network is down, but literally because your bank's risk assessment algorithm, decided your residency paperwork makes you a sudden regulatory liability.
And they just close your account overnight.
Exactly.
Hmm.
It's wild. We are looking at this massive, rapid overhaul of how the U.S. government handles non-citizen access to the American financial system. It's a lot to unpack.
It really is a critical time to be looking at the plumbing of the financial system, especially with that executive order signed just yesterday.
Yeah, the May 19th order. We're going to get into all of the mechanics of that. But real quick, before we jump in, please take a second right now to like, subscribe, follow, and turn on the notification bell so you never miss out when we deep dive into these complex topics.
Definitely do that.
And we also have a quick mandatory update we need to read for you. We are monitoring the Martin Stevens v. OpenAI matter, which is not a lawsuit, but are currently in a deliberate, voluntary, quiet period at Martin's request to idle the release of new public information. We want to be clear not to give the impression that a settlement is underway or being discussed. However, we can confirm that the dead man's switch has not been activated, meaning Martin is physically and legally safe.
Okay, so diving into the actual policy.
Wait, really quickly, I need to make a very explicit impartiality disclaimer first.
Oh, right, yeah. Good call.
Because the sources we're unpacking today, they contain highly politically charged viewpoints, policies, criticisms from both the left and the right.
And we are not taking sides here.
Strictly impartial. We are not endorsing any of the political positions presented in these documents. Our mission for this deep dive is just analytical. We're taking a stack of sources, so federal court rulings, legislative bills, financial agency alerts, and that brand new White House executive order from May 19th, 2026. And we're just breaking down the actual mechanics of how the government is trying to intertwine immigration enforcement with banking compliance.
Right, just looking at how the machine actually works.
Exactly. And, the best way I can think to frame this for you listening, it's like the U.S. financial system is an exclusive club.
Okay, I like that.
And suddenly the government is completely changing the instructions for the bouncers at the door. And now the bouncers, which are the banks, are just frantically trying to figure out how to enforce these new rules without accidentally kicking out the wrong people or, frankly, going bankrupt in the process.
That is exactly what's happening. But to understand why yesterday's executive order put so much pressure on consumer banks, like the bouncers in your analogy, you really have to look at why previous efforts failed.
Right, because this didn't start at the bank teller level, did it?
No, not at all. The government didn't start by trying to turn banks into immigration enforcers. They initially tried to use this, back-end data pipeline. So if we go back a bit, in April of 2025, the Treasury Department and the Department of Homeland Security quietly set up a data sharing system.
Okay, how did that work?
Well, Immigration Customs Enforcement, ICE, they compiled a list of about 1.2 million individuals that they suspected of being in the country without lawful status.
Wait, 1.2 million names just on a list?
Yeah, a massive list. And they handed that directly to the IRS.
Oh, wow.
Right. And then the IRS ran those names against its massive tax database and returned roughly 47,000 matches, which, provided ICE with highly accurate addresses and actual financial footprints for those people.
So they were essentially utilizing the entire tax collection infrastructure as a dragnet.
Exactly. But as you can imagine, that program hit a massive legal roadblock almost immediately.
Yeah, looking at the timeline in our sources, it didn't last long. What, November 2025?
Yep, November 21st, 2025. A federal district court judge issued a preliminary injunction that entirely blocked the IRS from sharing that data.
Just shut it down.
Completely. The judge cited a specific law, 26 U.S.C. Section 6103.
And that's the tax privacy statute, right?
Yeah, it's a statute that generally mandates that taxpayer information must remain strictly confidential, barring a few, very narrow exceptions.
And I'm guessing routine immigration sweeps do not meet that threshold.
The court essentially said absolutely not. But the judge's ruling went deeper into the functional mechanics of, why tax privacy even exists in the first place. You see, the IRS operates on a mandate of revenue collection.
Right, their job is to get money.
Exactly. And they have spent years, literally years, encouraging undocumented immigrants to file taxes using an ITIN.
An ITIN, that's an individual taxpayer identification number, right?
Yes.
For people who earn income in the U.S. and need to pay taxes, but they just aren't eligible for a Social Security number.
Correct. The unspoken agreement there has always been, hey, pay your taxes, and the IRS isn't going to act as a tip line for deportation.
Which makes sense from a revenue standpoint.
Right. But when that ICE data sharing program became public, it triggered this massive, immediate chilling effect.
I mean, predictably.
Yeah. Undocumented workers predictably stopped filing their taxes because they were terrified that their ITIN data was basically a homing beacon.
Going back to the club analogy, it's like building a firewall between the tax collector and the police. You know, you want people to pay the cover charge to get in, but if they think paying the cover charge gets them arrested, they're just going to sneak in the back door.
Exactly. And the court recognized that using the IRS for immigration enforcement was actively sabotaging the IRS's primary mission of collecting federal revenue.
Okay, so the court blocks the IRS. Does that effectively force the government to find a non-tax way to track this?
Yes, and they tried almost immediately. Around that exact same time, late November 2025, FinCEN, the Financial Crimes Enforcement Network, tried a different angle. They issued an alert requiring money services businesses. So, think of your standard storefront wire transfer services to file suspicious activity reports, or SARs.
For what kind of transactions?
For cross-border transactions over $2,000 if they suspected the funds involved illicit money or, quote, unlawful employment by illegal aliens.
Hold on, I want to pause on that FinCEN alert because the mechanism there just seems incredibly messy.
It is.
I mean, think about a cashier at a wire transfer storefront processing a remittance to another country. How on earth are they supposed to determine if the $2,500 being wired is the product of unlawful employment?
They really can't.
Right. They don't have access to the sender's I-9 work verification forms. Are they just supposed to guess based on the customer's appearance or what language they're speaking? That seems to invite a massive operational headache and, frankly, endless civil rights lawsuits.
That operational headache is exactly the defining feature of this entire policy shift. Because the court slammed the door on the IRS, acting as a centralized, back-end data pipeline, lawmakers and regulators realized they had to pivot.
They had to go to the front lines.
Yeah. If they couldn't run a silent, automated sweep of a federal database, they had no choice but to force the financial industry to check IDs at the front door. Which brings us to the sudden regulatory reversal we saw at the start of this year.
Right, January 2026. The Department of Justice and the Consumer Financial Protection Bureau, the CFPB, formally withdrew a joint statement.
A statement that had been on the books since October 2023, yeah.
And under that old 2023 guidance, lenders were heavily cautioned against considering a borrower's immigration status. Right?
Exactly. The fear back then was that flagging citizenship could violate the Equal Credit Opportunity Act, or ECOA.
Because it could act as a proxy for racial or national origin discrimination?
Right, but this January, the current DOJ and CFPB completely scrapped that. They reversed the framework entirely.
So what does the new guidance say?
It explicitly permits banks and lenders to factor in lawful residence status when assessing creditworthiness. The whole mechanism here is suddenly about risk modeling.
Ah.
The new stance basically argues that a borrower's legal authorization to remain in the United States and, earn a living is a mathematically relevant variable in determining whether they can actually pay back a 30-year mortgage or a 5-year auto loan.
So lenders are no longer threatened with disparate impact lawsuits just for asking about a visa expiration date?
Exactly.
Well, that clears the regulatory threat for banks who want to ask the question. But then the legislative branch stepped in to try and make it a mandate, didn't they?
Yeah, that brings us to Senator Tom Cotton's bill.
The Know Your American Customer Act, introduced in March of this year. Looking at the sources, the proposal pushes to make it an actual federal crime for illegal migrants to open or maintain accounts.
It's a huge escalation.
Yeah, it mandates that all FDIC and NCUA-insured institutions, NCUA being the equivalent of the FDIC for credit unions, would have to actively verify legal status.
Right, they'd need proof of citizenship, a green card, or a valid visa, not just a standard driver's license anymore.
But wait, here's where I found a fascinating detail in the sources. The bill contains a grandfather clause.
Yeah, it's a very revealing concession to the banking industry.
It really is. It explicitly states that the new verification mandates would only apply to new accounts moving forward. People with existing bank accounts would just be permitted to keep them without undergoing any retroactive citizenship audits.
Right.
But I want to push back on that because the stated ideological goal in Cotton's press releases is that access to the American banking system is this privilege reserved only for those who respect our laws.
Right, that's the rhetoric.
But doesn't grandfathering in millions of existing, potentially undocumented clients completely undermine that premise? Or is this just brute force administrative pragmatism?
It is 100% administrative pragmatism.
Because checking everyone retroactively is just impossible.
Completely impossible. Think about the legacy software systems at major banks. They don't just have a simple binary toggle for citizen versus non-citizen for an account that was opened back in 1998.
Oh, yeah, of course not.
The sheer cost in man-hours to retroactively demand, birth certificates or visas from 100 million existing checking account holders. It would likely paralyze the entire banking sector. The logistics of retroactive enforcement are functionally impossible without crashing the system.
So they just grandfathered everyone in to avoid a crash.
Exactly. And that exact collision between political directives on one side and banking logistics on the other is what shaped the centerpiece of our deep dive today. President Trump's executive order, signed yesterday, May 19th, 2026.
Okay, let's get into the EO. What does it actually do?
Well, the initial drafts of this administration's plan actually leaned heavily toward making Senator Cotton's vision a universal administrative reality. They wanted to require banks to collect citizenship data on all customers.
Oh, wow. But the banks clearly pushed back hard on that, right? Tremendously hard. The banking lobby essentially presented the White House with the math.
Like, here is what this will actually cost us.
Yeah. A universal mandate would require retooling literally every piece of account opening software. They'd have to retrain hundreds of thousands of employees.
Not to mention the PR nightmare of accidentally debanking legal U.S. citizens who just couldn't find their birth certificate fast enough.
Exactly. The compliance cost would have been astronomical. So the final executive order represents a compromise. It abandons that universal citizenship check.
Okay, so what's the alternative?
Instead, it directs Treasury Secretary Scott Bessent to rely on a red flag system by proposing changes to the Bank Secrecy Act.
Okay, we really need to break down the mechanics of the Bank Secrecy Act, or the BSA, because that is not just a gentle suggestion to banks.
No, it's a structural weapon.
Exactly. The BSA essentially deputizes banks as an extension of federal law enforcement. If a bank misses a suspicious transaction, the regulators don't just send a polite warning letter. They fine the bank millions, sometimes billions of dollars.
Right, the stakes are incredibly high.
So what are the specific red flags this new executive order is telling banks they have to look for now?
Well, regulators are instructed to issue advisories on several patterns. Things like accounts opened under opaque shell companies, signs of off-the-books wage payments, financial patterns indicating labor trafficking.
Okay, those seem somewhat standard for anti-money laundering.
They are. But the most targeted new red flag involves the use of ITINs.
Going back to the tax numbers.
Yes. The EO says if a prospective customer attempts to open an account or obtain credit using an ITN, and they cannot simultaneously provide a Social Security number or a verified work visa, the bank is instructed to flag that account.
Wow.
And the order also specifically targets the use of foreign consular identification cards, like the matricula consular issued by the Mexican government, which are frequently used by undocumented individuals to establish identity.
Okay, wait, let me challenge this idea that this is a compromise by the administration. If the White House backed down from forcing banks to do an overt universal citizenship check, but then immediately turned around and mandated that banks flag the use of an ITN without a visa, isn't that just a backdoor way of achieving the exact same result?
It kind of is, yeah.
It seems like instead of the government absorbing the political blowback of a blanket rule, they just shifted the burden of playing detective entirely onto the compliance departments of private banks.
That mechanism of shifting risk is exactly how modern financial regulation operates. By framing this through the Bank Secrecy Act, the government essentially recategorizes immigration status from a civil issue into an anti-money laundering and illicit finance issue.
So if a bank teller fails to catch an ITN red flag,
then the bank's compliance algorithms are now technically failing to detect potentially illicit activity, and they face those massive fines you mentioned earlier.
that is a huge shift. And the sources show the executive order goes way beyond just basic checking accounts, too.
Oh, absolutely.
It also directs the CFPB to alter how lenders calculate the ability to repay standards for mortgages and auto loans. We talked earlier about the DOJ clearing the legal path to let banks consider residency, but this EO takes it a step further, doesn't it?
It does. It directs the CFPB to actively require loan officers to factor in the potential for deportation and sudden wage loss when underwriting a loan for a non-citizen.
Wow.
The downstream effect of that directive is profound. It forces mortgage originators and auto lenders to build these complex actuarial models, estimating the likelihood of a borrower being deported before a 30-year mortgage or a 60-month auto loan matures.
That sounds incredibly complicated to model.
It is. And the risk premium added to those loans will likely price a massive segment of non-citizens completely out of the credit market.
They just won't be able to afford the interest rates.
Exactly. And we really should contextualize this within the administration's broader financial strategy that rolled out yesterday. This EO wasn't signed in a vacuum.
Right, there were other actions yesterday.
Yeah, the president also signed an order regarding non-bank financial institutions' access to the Federal Reserve's payment systems, and he signed the Genius Act, which is aimed at establishing U.S. dominance in digital currency.
So the administration is executing this highly coordinated structural overhaul of who gets to use the financial plumbing and how that plumbing operates on a global scale.
Precisely.
Okay, so we've established the policy mechanisms. We've got the shift from IRS back-end sweeps to front-door bank compliance. We have the new red flags, the changes in underwriting algorithms. But what does this look like on the ground?
That's the big question.
Right, let's talk about the real-world fallout. How does shifting this massive regulatory burden onto private financial institutions actually alter the consumer landscape?
Well, the immediate reaction from the banking sector is one of intense caution. The American Bankers Association CEO Rob Nichols released a statement emphasizing their support for a secure financial system, but he very carefully stressed the need to maintain consumer access to banking services.
Basically saying, we want to follow the rules, but we don't want to lose all our customers.
Exactly. They're currently analyzing the EO to determine how to even operationalize these red flags without incurring massive liabilities. But industry analysts, including Ed Mills from Raymond James, are predicting a severe wave of what they call debanking.
Let's look at the unit economics of debanking for a second, because it's purely rational from a corporate perspective.
100%.
Think about it. A standard checking account might only generate, what, $50 or $100 a year in revenue for a bank?
Somewhere in there, yeah.
But if that account holder uses a foreign consular ID and the new Bank Secrecy Act rules require a compliance officer who probably makes $150 an hour to manually review that account every quarter and file suspicious activity reports, that customer instantly becomes a massive financial loss for the bank.
Exactly. The bank's path of least resistance is to simply close the account. It is infinitely cheaper to just terminate the banking relationship en masse than to absorb the compliance man-hours and the existential threat of a federal fine.
Wow.
And immigration advocates, highlighted in the source material, are deeply concerned about the psychological impact of this dynamic. They warn that the mere announcement of these red flags is going to spark a quiet bank run within immigrant communities.
Because they're afraid of being flagged.
Right. The fear that an account could be flagged and reported to federal authorities will drive people to proactively withdraw their funds, pushing millions out of the regulated system entirely.
Which leads us to, I think, the ultimate unintended consequence here. It sounds like the financial equivalent of squeezing a water balloon.
Okay, how so?
Well, if you squeeze undocumented workers out of the regulated banking sector, their economic energy doesn't just evaporate. People still need to buy groceries, they need to pay rent, they need to get paid for their labor.
Right.
The financial activity just bulges out into the shadow economy. We are talking about an explosion in predatory payday lending, exorbitant check cashing fees, and just a massive influx of unregulated, untraceable cash transactions. So the question is, does establishing these strict perimeters actually make the U.S. financial system safer and more transparent? Or does it just blindfold the government to billions of dollars in daily economic activity?
That paradox you were pointing to is actively being debated by national security analysts right now. By weaponizing banking compliance to enforce immigration, the policy heavily incentivizes the creation of an opaque, cash-heavy economy.
Yeah.
When millions of people are debanked, the government loses visibility. FinCEN can no longer track those funds, which means genuine illicit finance like actual money laundering, organized crime, or terror financing can more easily hide within that massive, newly formed shadow economy.
And that reality leaves you, the listener, with a truly provocative question to mull over.
Yeah, think about this.
If traditional, heavily regulated banks become simply too risky or computationally expensive for non-citizens due to these layered federal compliance rules, and if these populations are forced to turn to cash or unregulated digital alternatives just to survive day to day, could these government crackdowns unintentionally act as the greatest catalyst for the mass adoption of parallel, decentralized financial systems?
It's a huge possibility.
Right. Are we watching federal policy accidentally accelerate the construction of a shadow financial infrastructure,
Huh.
perhaps running on the very digital currencies mentioned in that Genius Act that the government ultimately has absolutely no ability to monitor or control at all?
It's a scenario where the attempt to tightly control the existing system might just fund the creation of its replacement.
That is wild to think about. We will definitely have to see how the banks begin rewriting their algorithms in the coming weeks. Thank you so much for joining us on this deep dive.
Yeah, thanks for tuning in.
If you found this breakdown valuable, please take a moment right now to like, subscribe, follow, and turn on the notification bell so we can keep bringing you these deep dives. And finally, our mandatory statement once again. We are monitoring the Martin Stevens v. OpenAI matter, which is not a lawsuit, but are currently in a deliberate, voluntary quiet period at Martin's request to idle the release of new public information. We want to be clear not to give the impression that a settlement is underway or being discussed. However, we can confirm that the dead man switch has not been activated, meaning Martin is physically and legally safe. Thanks for listening, and we'll catch you on the next deep dive.